Alright, let's play a quick game. Imagine you buy an investment property that's losing you $300 a week and you're happy about it. Sounds insane, right? Well, that's exactly what tens of thousands of Australians are doing, deliberately running their properties at a loss every single year. And yet, they're smiling when tax time rolls around. Why? Because those losses are working overtime behind the scenes, slicing thousands off their taxable income, sometimes turning a painful mortgage into a wealth-building machine. This is called negative gearing, and depending on who you ask, it's either the smartest tax play in Australian real estate or one of the biggest financial traps middle-class investors ever walked into. In this video, we're going to break down exactly how negative gearing works, the real numbers, the fine print, the sneaky property tax tricks that few accountants talk about, and how you can use, or avoid, them like a pro. Stick around till the end, because I'll show you one lesser-known trick that seasoned investors use to legally squeeze more deductions from their investment, even before their first tenant moves in. And, quick reminder, nothing here is financial advice. I'm not your accountant, I'm just a guy on the internet who reads way too many tax rulings and property forums. Alright, let's get started. So, what exactly is negative gearing? At its core, gearing just means borrowing money to invest. If you borrow to buy shares, that's gearing. If you borrow to buy property, that's gearing. Now, if your investment makes more money than it costs to hold, that's positive gearing. You're earning a profit. But if the expenses, like loan interest, repairs, insurance, management fees, are greater than your rental income, you're negatively geared. You're making a loss. A real, literal loss. And here's the kicker, the Australian Tax Office allows you to offset that loss against your other income. That means if you earn $100,000 a year from your job, and your investment property loses $10,000, you can potentially reduce your taxable income to $90,000. You still lost money overall, but you get a tax refund that softens the blow. That's the essence of negative gearing, turning a short-term cash flow loss into a tax benefit, with the hope that capital growth will make up for it when you eventually sell. Now, to be crystal clear, the strategy isn't about losing money for fun. It's about using the tax system to cushion the early years of an investment that's expected to grow in value over time. Think of it like this, you're paying the ATO a little less now, in exchange for taking on some risk that property prices will rise later. Let's talk psychology, because this is where negative gearing gets interesting. Australians love property. It's practically a religion here. And for decades, people have been told that properties never goes down, that if you just hang on long enough, the capital gains will dwarf any temporary losses. So investors buy properties that don't quite pay for themselves, knowing the tax system will help shoulder the pain while they wait for capital growth. Here's how it works in practice. Let's say you buy a $700,000 apartment in Brisbane. Your loan is $600,000 at 6% interest, that's $36,000 a year in interest alone. You're getting $550 a week in rent, so about $28,600 per year in income. Add in maintenance, insurance, property management, maybe another $4,000. So in total, you're spending $40,000 a year and earning $28,600. That's a $11,400 loss. Normally that'd hurt, but at a 37% tax rate, that $11,400 loss cuts roughly $4,200 off your tax bill. So yes, you're still down $7,000 in real cash flow, but your investment cost you less after tax, and if the property grows 8% in value that year, that's $56,000, your overall position looks fantastic on paper. That's why investors love this trick. It smooths the pain while you wait for appreciation. Let's get nerdy for a second, because this part determines whether you actually save money or just burn cash. Under Australian tax law, almost every cost associated with earning rental income is deductible. That includes loan interest, not the principal, just the interest portion. Property management fees. Maintenance and repairs, but not initial improvements before you rent it out. Council rates and insurance. Depreciation, and this one's huge. Travel expenses, limited nowadays, but certain exceptions apply. The ATO even allows you to claim the depreciation on things like appliances and fittings. So let's unpack depreciation, because it's one of the sneakiest and most misunderstood ways investors juice their deductions. There are two main categories. Division 43, capital works, the structure of the building itself, walls, roof, etc. Usually you can claim 2.5% per year for 40 years. Division 40, plant and equipment, things that wear out faster, like carpets, ovens, air conditioners. These depreciate over 5 to 10 years. Now, here's where the real trick kicks in. You can hire a quantity surveyor, companies like BMT Tax Depreciation or Washington Brown, to prepare a detailed report of every depreciable item in your property. That report can easily find you $8,000 to $12,000 a year in deductions that you might otherwise miss. Seriously, if you own an investment property and haven't done this, call one of those firms. They'll send someone out, measure your doorknobs, and suddenly you're shaving thousands off your taxable income. Let's keep the numbers rolling. Suppose your depreciation schedule gives you an extra $9,000 deduction. Your total paper loss jumps from $11,400 to $20,400. At a 37% tax rate, that's $7,500 in tax savings. Even if you're out of pocket $11,000 in cash flow, you've still reclaimed $7,000 back in tax. That means the true after-tax cost of holding that property is just about $4,000. Less than $80 a week. And that's before capital gains. Now you're starting to see why property investors swear by this system. Here's the easy way to think about it. Every dollar you lose on paper through your investment can reduce the tax you owe on your salary. If your income puts you in a 45% tax bracket and you have a $10,000 negative gearing loss, you could save $4,500 in tax. It's like the government agreeing to pay nearly half of your loss, as long as you can afford the rest and wait for property prices to do their thing. But, and here's where Graham Stephan's skepticism comes in, this only works if the property actually grows in value. If property prices stall or decline, you're literally paying to lose money each year, with no offsetting gain. That's not investing, that's subsidized gambling. So yes, the tax benefit is real, but the strategy only works if your investment fundamentals are strong, good location, rental demand, long-term growth prospects. Now let's address the elephant in the room. When you eventually sell, the ATO wants a piece of your profit, that's capital gains tax, CGT. The good news? If you hold the property for more than 12 months, you only pay tax on 50% of the gain. So, if you make $200,000 profit after 5 years, only $100,000 is added to your taxable income. Here's why that's powerful. During those 5 years, you might have claimed $20,000 to $25,000 a year in deductions through negative gearing, lowering your taxable income every year. Then when you sell, you only pay tax on half your gain. Essentially, you're deferring tax for years and then paying a discounted rate later. That's the real magic of the strategy. It's not just about losing money and claiming it back, it's about timing when you pay tax. But again, timing cuts both ways. If you're forced to sell early, or in a downturn, that tax benefit can evaporate fast. Alright, this is the part most YouTubers skip because it doesn't sound sexy. But if you want to invest intelligently, you need to understand these pitfalls. Cash flow risk, you need to cover those monthly shortfalls. If interest rates jump or your property sits vacant, your budget can implode. Interest rate risk, at 2%, negative gearing looks like a genius move. At 6.5%, you're suddenly bleeding thousands. Legislative risk, negative gearing rules have survived a dozen elections, but that doesn't mean they always will. Labour and the Greens have repeatedly called for restrictions. Market risk, property doesn't always go up. Look at Perth between 2014 to 2019, 5 years of flat or negative growth. If that happens while you're negative geared, you're losing on both ends, cash flow and capital. So while the tax deduction feels good now, always remember, it's still a deduction on a loss. you're better off making money and paying tax than losing money to get a refund. Let's summarize where we're at. Negative gearing equals property making a taxable loss. That loss offsets other income, saving tax now. Depreciation and deductions magnify the effect. It only truly pays off if capital growth exceeds your annual shortfalls. The system's heavily used by high-income Australians and politically sensitive. Alright, next, we'll go even deeper into the advanced tax tricks investors use, the legal ones, plus some you should absolutely avoid if you don't want an ATO letter in your mailbox. But before that, if you find this breakdown helpful and want to run your own numbers, check out the free calculators at domain.com.au or realestate.com.au. They've got handy negative gearing simulators where you can plug in your income, loan, and rent to see your after-tax position. And if you're serious about property investing, I'll link a few of the best quantity surveyor firms in the description below. BMT and Washington Brown both have solid reputations and can usually get your depreciation schedule done in under 2 weeks. Alright. Time to get into the good stuff, property tax tricks and strategies. We're talking about timing, structure, and paperwork, 3 areas that can turn a decent investment into a tax-optimized machine, or an ATO nightmare if you mess it up. Let's start with one of the oldest, yet smartest, moves in the game. 1. The pre-purchase repairs trap, an opportunity. Let's say you buy a rundown investment property that needs $20,000 worth of repairs, painting, fixing the roof, new carpets, maybe a new bathroom. Now, you might be thinking, perfect, I'll claim that as an expense. Not so fast. The ATO has a specific rule: repairs made before you rent out a property are not deductible as immediate expenses. They're considered initial repairs, meaning they improve the property's value and must be added to the cost base for CGT instead. However, and this is the trick, if you wait until after the property has been rented, even for a short time, then perform those same repairs, they can be claimed as immediate deductions in that financial year. So timing matters massively. The difference could be thousands in tax savings just based on when you fix that broken tile. I've seen investors deliberately list their property for rent, take on a short lease, then do the repairs afterwards just to make those expenses deductible. It's legal, as long as you follow the ATO's definition of repairs to an income-producing property. 2. Prepaying interest, the year-end hack. Here's another slick move that's 100% legitimate. Let's say you've had a high-income year, maybe a work bonus or extra freelance income, and you want to lower your taxable income before June 30th. Many lenders allow you to prepay up to 12 months of interest on your investment loan. By doing this, you can claim the entire prepaid amount as a deduction in the current financial year, even though it covers future interest. Example, you prepay $30,000 of interest in June for the next year. That's an instant $30,000 deduction this year, and your tax refund could easily cover a good chunk of it. It's a classic bring-forward strategy, and if you're in a high tax bracket now but expect a lower income next year, it's even more effective. Of course, you need lender approval and enough cash flow to prepay, but this move alone can make your tax return look very, very friendly. 3. Splitting loans for better deductibility. This one's subtle, but powerful. Many property investors make the mistake of combining their investment and personal loans into one account or offset. Big mistake. When you blend personal, non-deductible, debt with investment, deductible, debt, you muddy the water for the ATO. Instead, the smart move is loan splitting, keeping your investment property loan separate, so every dollar of interest is clearly deductible. Some even go further, they use interest-only loans for the investment property, while aggressively paying down their owner-occupied mortgage. That way, your non-deductible debt drops faster, while you maximize deductible interest on your investment side. It's a bit of financial jiu-jitsu, but it works. Banks like Macquarie, AMP, and NAB even structure investment packages for this purpose, always worth comparing. 4. Using trusts and company structures, advanced level. Now, this is where it gets spicy. Some high-income investors don't buy properties under their personal name at all. They use family trusts, unit trusts, or company structures to hold the asset. Why? control and flexibility. A discretionary trust, for example, lets you distribute income or losses to beneficiaries in a tax-efficient way. You might distribute to a spouse in a lower tax bracket, or even to adult children, within limits. The downside? Losses from negative gearing can't be distributed, they're trapped in the trust until future profits offset them. So if you're negatively geared from day one, a trust might delay your benefit. But long-term, if you expect strong capital gains, it can make sense, especially when combined with other tax planning tools. A company can also hold property, but remember, companies don't get the 50% CGT discount that individuals do. So if your play is long-term appreciation, think carefully. Bottom line, get a property-savvy accountant before you go anywhere near these structures. And yes, it'll cost you, but as Graham Stephan says, paying for good advice is cheaper than paying for bad mistakes. 5. The depreciation maximizer, quantity surveyor trick. We talked earlier about depreciation, and now let's push that to the limit. When you buy a newly built or recently renovated property, you can claim depreciation on both the building and its fittings. But when you buy a second-hand property, you can only claim depreciation on the structure, not on previously used plant and equipment, thanks to 2017 rule changes. Here's the twist. If you do renovations yourself, even minor ones, those new items become new assets, and you can claim depreciation on them. So replacing an old oven, repainting walls, or installing new blinds doesn't just make the place nicer, it creates new deductible assets. You can even ask your quantity surveyor to split the renovation costs for maximum effect. BMT and Washington Brown both specialize in this kind of scrapping schedule, where they identify the write-off value of old assets you're removing and the new assets being installed. That can mean claiming thousands in the same year, even if your out-of-pocket renovation cost wasn't huge. Smart investors time these upgrades strategically, usually around the end of the financial year. 6. The holiday rental loophole. Here's one that's recently caught attention, and some heat from the government. If you own a holiday home or short-stay property, like an Airbnb, you can still claim negative gearing deductions if it's genuinely available for rent. However, that's where people get greedy. The ATO has started cracking down on owners who claim deductions for holiday properties that are available for rent, but only for a week in January, and only to friends. Yeah, that doesn't count. To be compliant, the property must be actively listed on the market at a competitive rate. That said, if you play it right, renting it even part of the year, you can still claim a proportionate deduction. According to a Guardian Australia analysis, short-stay negative gearing alone is costing taxpayers up to $550 million a year in lost revenue. So yes, it's lucrative, but tread carefully. If the ATO audits you, they'll look at your booking history, price points, and advertising records. Pro tip, if you're going to claim, keep everything documented, screenshots, invoices, Airbnb listings. This isn't financial advice, but it's called audit proofing. 7. Renovation write-off timing trick. Another classic move involves the timing of upgrades. If you renovate right before renting, as we said, those are capital improvements. But if you renovate after a tenant leaves mid-year, many of those costs become deductible repairs. Savvy investors plan their maintenance cycles around tenancy breaks. You'll see some even delay certain works just to align them with the tax year. The difference? You might claim $8,000 this year instead of waiting 5 years to recover it through capital gains tax adjustment. It's all about sequencing. 8. The offset optimizer's technique. One of the more underappreciated strategies involves how you use your offset account. Let's say you have $100,000 in savings. Instead of dumping that into your investment loan, which permanently reduces the balance and your deductible interest, you keep it in an offset account attached to your investment mortgage. That way, you still reduce your interest expense day to day, saving you money, but you maintain the flexibility to move those funds later without changing your deductible loan balance. It's a neat way to stay tax efficient and liquid. As your portfolio grows, this flexibility is worth gold. Many high-level property investors swear by this trick, and lenders like Commonwealth Bank and Westpac now offer investment offset accounts specifically for this purpose. 9. Using property management fees and travel smartly. Even though the ATO cracked down on travel deductions in 2017, some investors still sneak in small wins. If you manage multiple properties or have a genuine property management business, travel to inspect properties can still be deductible. Also, if you use a platform or software for management, like PropertyMe, Released, or Yardi, those subscriptions are fully deductible as part of your investment admin. It's not glamorous, but those small bits add up, and they're low-hanging fruit most people forget. 10. Combining gearing with capital gains discount. Here's the ultimate synergy. If you've negatively geared for years, taking consistent deductions, and then you sell after holding the property for over 12 months, you get the 50% capital gains tax discount. So not only have you been deferring tax and boosting cash flow, you also get a discount on the final gain. That's the holy grail of long-term property investing in Australia, and why the system's so politically controversial. Critics argue it benefits high-income earners the most. And they're right, but if the rules exist, smart investors use them. If you're serious about mastering these strategies, here are a few resources I'd recommend checking out. BMT Tax Depreciation, great for free depreciation estimates before you buy. Washington Brown, another solid quantity surveyor, often cheaper for older properties. Finder.com.au's negative gearing calculator helps you run real numbers instantly. ATO's Rental Property Toolkit, free and surprisingly useful for clarifying what's deductible. And remember, if you ever get an ATO love letter, the first call you make should be to a qualified property tax accountant. I'd personally recommend firms like KHI Partners or Ban Tax Accountants, both specialize in property investors. 10. What could change, and why you should care. Here's where things get a little political. Every few years, someone proposes to scrap or limit negative gearing, usually during election season. The most recent proposals have included limiting negative gearing to new builds only, restricting deductions to one property per investor, or phasing it out completely for future purchases. According to the Parliamentary Budget Office, doing this could raise billions in revenue, but it would also shock the housing market. The Greens and ACOS have both pushed for reforms, arguing negative gearing inflates property prices and benefits wealthier investors. Meanwhile, investor groups and developers argue it's essential for keeping rental supply healthy. So far, no government's been brave enough to pull the trigger entirely, but reforms are being floated, especially for short-stay properties and multi-property portfolios. If you're planning to invest in the next few years, pay attention to election policy announcements, because a rule change could dramatically alter your returns.